Welcome to the Manifestation and Money podcast, Ryan.
Thank you. Good to be here.
Yeah, I'm so happy to have you on here. And if you could share with the listeners a little bit about who you are and what your story is.
Yeah, so I grew up in a pretty normal middle class family in a small Massachusetts town with two brothers and loving parents who followed the traditional route, go to school, get a job, invest in a 401k till it's time to retire. And now, since I was younger, I've always been interested in personal finance and investing and was great with numbers growing up. So when it came to college, I pursued my degree in finance and economics, followed by getting my master's in business administration. And right after college, started as a financial advisor, dealing with people of all tax brackets in a one-on-one capacity, focusing on anything from insurance to stocks and fixed income investments. However, I quickly realized that wasn't for me, and I left that job to take on more of an analytical role with the New York Stock Exchange and then started my own business in real estate. So I've had a lot of experience with various asset classes and different investor types. Now, at the start of my real estate journey, this was probably 2020-ish. I was getting really into reading books on business, investing, mindset, you name it. And just like a lot of real estate investors, I got my start with the Rich Dad Poor Dad, which really sparked my interest in real estate. And just under a year later, one of my close friends and now business partners asked me if I wanted to get an apartment together. And I responded with, how about we figure out how to buy a place and become the landlords to live for free? And at the time, I didn't know that the term for this was house hacking, but thankfully he was in and we dove headfirst into it together, house hacking a triplex, living for free, with a little bit of extra cash flow to pay for some expenses like utilities. Then about a year later, we house hacked another property, adding 2 more units to the portfolio. And seeing the benefits, we were thinking about how can we really scale this thing and make it accessible to others. So then we sought out masterminds, found a mentor, and started syndicating properties and formed our own company, TR Capital Partners. And since then, we've been able to acquire 464 units, partnering with investors who want the benefits of real estate without the hassle and learning curve of being a landlord or adding time to their busy schedules. So went from taking the leap on a triplex 4 years ago and having scaled it up to having ownership and stake in about 464 units as of today.
That is fascinating and mind-blowing because that is a short period of time. In somebody's lifetime, you hear the people, the woulda, shoulda, coulda, I should have gotten into real estate. I'm too late to get into the game. But in 4 years, that is a substantial track record. So I want to go back to the beginning for a second. So reading Rich Dad, Poor Dad, that was a huge spark for me too. So I totally resonate with that. There's just something in there. And is that what sold you on the thread of real estate would be the way to go?
Yes, I think it was more the lessons he taught. And obviously, he's a big real estate investor. So it kind of all ties together. But the big things were the rich don't work for money and a lot about taxes and pretty much keeping your money and putting it to work for you. Real estate checked all those boxes. So that's kind of where I got that spark and then really just dove into all his other stuff, which is more just financial literacy based, kind of mimicking what the rich do. Obviously, you don't want to reinvent the wheel. Everything's been done before. So there's a playbook for everything out there that you're trying to do. And his was the playbook I started to follow, and then eventually branched off into the syndication model and stuff like that. So it was definitely the spark for me, I would say.
Mm-hmm. Yeah. And so then you decide you're going to buy a place with your buddy. And is this the person who you have started up your real estate partnership company with?
It is. Yeah. We've been there
Okay.
since day one together. We actually grew up together, so it makes it a lot easier since we're 7, 8 years old. So the trust factor was already there, which helps a lot.
That I think would be huge. So you buy a triplex, like a 3-unit property. And did you guys share one unit together and then rented out the other 2 units? Or did you guys each take up a unit and then rent out the third?
No, we rented out 2 units, stayed in the first one. They were all 2 bed, 1 bath, so it was pretty easy. It wasn't the biggest apartments, but thankfully we had a friendship already, so we didn't get annoyed with each other and everything like that. But we wanted to maximize essentially or optimize our situation and live for free was the goal, at least on the first property. Obviously, it spiraled from there, but yeah. So we rented out the top 2, lived in the bottom unit.
Yeah, I like that because in the FIRE movement, which a lot of the listeners on here are a part of, they're trying to strive for that financial independence and early retirement. And a lot of them are willing to make those uncomfortable choices, right? Sure, your first property, you go out there, you can each have your own living space. This is my first place that we purchased, bought our own. But to make the choice for you two to live together in one unit, you are totally maximizing your potential from those other 2 units. That's fascinating. And that's fun that you two grew up together and now you're in business together. Can you explain what syndicated means? What does syndicating properties mean?
To tie it all together, it's pretty much getting the benefits of real estate without having to be the landlord and deal with tenants and maintenance calls. So essentially, there's two parts to it. There's the general partners, which is my team, me and Lucas, my business partner, and then the limited partners, which is people who just want the passive benefits. So pretty much what we do is we find the asset, we go through acquisitions, the financing, the debt side of things, the equity side of things, and then actually manage the property post acquisition. That includes a business plan, property management, overseeing the asset as a whole. And the limited partners, essentially just that know, like, and trust us, will pretty much park their money in a deal, get the cash flow, equity gains, and tax benefits from ownership of real estate, but really don't have to do any of the back end stuff and the hard work or the months of preparation before buying a larger asset that goes into it before actually purchasing it. So we pretty much take care of everything as far as acquisitions, landlord duties, and have that expertise and knowledge base, while the investors can trust us to execute our business plan and reap the benefits without having to really do anything. So
Mhm. So you guys started off with 3 and 4 bedroom or 3 and 4 unit properties. What is your favorite kind of property to purchase today?
100% commercial real estate. So multifamily. We only do apartment buildings for the most part. The real estate, the difference from commercial to residential is commercial properties are valued based off of the income they bring in, the profits they produce. So we have direct control essentially over the value of the asset. So we can achieve a lot higher returns because all we have to really do is find something that's not maybe running our operational efficiencies not very well. So we can go in, update units, boost rents to market, and then take care of the expenses by properly managing it. So that impacts the NOI and or the profits right away, which in turn boosts the value of the property. With residential real estate, it's more so based off comps in the area. So if you own like a single family home or a 3 family yourself, you would probably know that your asset, your house, is based off of like your neighbor, how much they sold their house for, or the neighborhood in general. So a lot of that's out of your control, which is one thing that we learned after purchasing our first two properties. And that's why we scaled up to the commercial side, because the whole point of us doing this was to have more control over our finances. Like you said, the FIRE movement, be able to retire early, take control of your financial worlds. And that was the next level for us, was to take care of the actual control of our assets and the value of those. So we can actually strategically plan on, boosting the value there to get higher returns than we would in residential real estate.
Mm-hmm. And when the lenders are looking at you guys and looking at commercial lending wise versus residential, they're taking you as the individual out of the picture too, right? Like are they looking more at the property making the money versus how much money did you make last year, which you have to do when you qualify for residential, correct?
Correct. Yeah. The only difference is we have to have someone on our team, whether it's us or we partner with other groups, that has a net worth or a balance sheet that it exceeds or is equal to the value of the property we're purchasing. So say it's a $10 million apartment building, we need to collectively as a GP team have that as on our balance sheet to show that we can have collateral for this asset. But it is based off of the income it's bringing in, not so much your personal finances like a residential property would.
Okay, gotcha. So when you guys are sourcing out buying these bigger commercial buildings, what are you looking for? What is the cash cow property, if you will, that you guys really like to purchase?
Yes, there's a lot of economic indicators we look for depending on the market. There's a lot of things with the property we look for. What kind of a high level overview would be: one, we focus specifically on emerging markets that are landlord friendly. So we want to be able to find somewhere where there's job growth, there's rent growth, there's population growth, and job diversity. So it's not just relying on one industry. So, say if that industry takes a hit, then the market itself will. Also, we want to make sure that we're not investing in a market where there's a ton of new build going on, because we don't want to compete with these larger new A-class assets that could potentially take tenants away from us. So those, as far as the market, that's what we look for. And then for a property, we really want to look for something that has some deferred maintenance, that has value add potential, whether that's adding amenities, updating units, making it more of a community feel, or simply just operating it better by hiring a proper property management team. So in that way, we can find properties that are underperforming, boost the performance there, which, like I mentioned before, will essentially increase the value of the asset, and then pass those benefits on to the investors that have entrusted us to execute this business plan. So a lot goes into it behind the scenes, but that's what we're here for, to take that away from people just looking to get the benefits without the landlord and acquisition hassles.
And let's flip that on its head for a second. What are the red flags that you guys avoid when you're doing all that analysis?
Well, a lot of times people will base their purchase price, we'll say, off of projected numbers.
Mhm.
That's one thing. If you're talking to a GP team, you want to make sure they're doing it off the actual performance of the property, because regardless if you can hit those numbers or not, that's not how much the property is worth. So one thing is it comes down to the underwriting of the asset. You want to make sure you're asking people very specific questions about how they value the property and then how they plan to get to their goal and the business plan in between. Another red flag that we don't like is certain things like the plumbing and electric. And we find all that stuff during our due diligence process. But typically, we only purchase buildings that are 80s vintage, meaning 1980s builds or newer, because the older properties tend to have cast iron piping or aluminum electrical wiring. And we often have to go in and replace those or consistently have to repair and maintain those things, which adds to our expenses, adds to our capital expenditures, and can really kill a deal if not managed properly. So the due diligence side of the acquisitions is maybe even more important than actually finding the property itself. So there's a lot of things that go into it, a lot of things that can pop up, but we find all that stuff in like our 30 to 60 day due diligence period where we meticulously analyze and actually visit the property and do everything we need to do to make sure what we're being shown from the broker or the seller is actually what we're getting. Because a lot of times people will throw together a nice pitch deck for you, but leave out some of the issues that the property might have.
Yeah, I believe that. And I'm sure you guys have been doing it in the 4 years, compile the amount of doors that you guys have. You have probably learned a lot of lessons, if you will, of what is good, what is bad, what people have hidden. Can you share just some of those top moments of things that you've learned so far on your journey?
I think it more so is what like due diligence period when we're walking properties and looking at these things. Our mentor that has helped us immensely as far as learning what to look for, little things as far as like cracks in the foundation or how the gutters and stuff are in the building, just small things that could really impact the actual foundation of the property. As far as looking at stuff brokers send us and talking to people that are selling, reviewing financials meticulously to make sure that everything lines up correctly and there's nothing that's being, I guess we could say, amplified to make the property look better than it is and boost the value on the sale. So I think having a mentor can really accelerate your growth and catalyze your progress, and you can avoid mistakes they've made in the past. Thankfully, we've had a good mentor. We've avoided major mistakes. We've even had deals under contract and then eventually went in and decided to kill the deal because of certain things we found during the due diligence period. But we wouldn't have known to look for those things if it wasn't for that specific mentor that was helping us out on those deals.
Yeah, valuable to have a mentor by your side that's there with you guys. I'm sure that has helped exponentially just in your confidence to be able to go into properties and move at the speed you guys have moved at. I kind of have two questions here for you. It's going to be at both ends of the real estate investing scale. So the first one would be for somebody who's listening, who's maybe like your age, who's wanting to get into the real estate game. What is your piece of advice for them?
So I like the way I started personally. So with the house hacking model, essentially you can live in a property, you get 3.5% down for your down payment. So it's relatively cheap to actually purchase the property. You can live there, you can manage tenants, even though there's only one or two. You can go through renovations yourself and do a lot of it on a smaller scale, get those learning lessons, live for free for a little bit so you can bank more money and potentially scale. But I love the house hack model to start. A lot of people will say skip that and go big, but there's so many things to consider on the larger side of commercial real estate and the bigger assets where if you don't have any experience and you just jump right into those, you're bound to make some major mistakes. And those properties have a bigger price tag, which means those mistakes cost you more money. So I'd recommend starting small. Like I said, the house hacking model for me was the easiest way to get in for relatively cheap and really live for free, which gave me time to take care of my other financial stuff in my financial world, to take care of expenses, stuff like that, and really get everything lined up correctly to pursue the next property and the next one and the next one.
And isn't that a fun perspective of quite often people are striving for buying properties so that one day they can live mortgage free, right? So to be able to start out of the gate with your first real estate purchase to be like, I'm going to be living in this property with my living expenses covered. I think that's just a fascinating way to start out in the real estate game when quite often that is people's end game in some sense, right?
Yeah, and it's great because I mean, people around my age, we're paying student loans, whether we maybe just got a new car or whatever it might be. We have stuff to pay for. So if you can have someone else paying your mortgage, which is one of your biggest expenses, whether it's rent or mortgage, you have so much extra cash to kind of free up and parked in different investments or not have to live paycheck to paycheck, which for me the financial side of things, peace of mind is number one. So I think sacrificing if you have to for a year or two in order to at least build that base is 100% necessary. And I'd highly recommend it. I wouldn't change anything looking back on what we were able to do. So
I believe that. That's great. Now, the other end of the real estate scaling question here.
I'd say depending on how much money you have to invest, the syndication model is great because you're investing passively like you would in, we'll say, a REIT or a stock or a bond, but you're not a shareholder, you're an owner. So you're getting all the ownership benefits. You're getting cash flow typically on a quarterly basis. You're getting tax benefits every year. You're getting all the benefits that you would want from owning a piece of real estate without having to deal with annoying tenants and those late night maintenance calls that happen to come at the worst times when you're out of town and they need immediate attention. Plus, all this stuff is really managed for you. So your expertise doesn't have to be there and the knowledge base doesn't really have to be there as much as you would if you were managing your own properties. Typically on the syndications, the lowest you'll have to invest is mostly around 25,000. The average is roughly 50 to 100,000. So that's a lot of money for some people. However, if you're looking to get the benefits without having to deal with the tenants, toilets, and the maintenance side of things, that's definitely the route I think you should go.
Mm-hmm. Absolutely. So on that note, can you share with the listeners how they can reach out to you and your company and get more of your expertise?
Yeah, so you can visit my website at trcapitalpartner.com. There you'll find a bunch of educational resources, past webinars, ebooks, and a lot of other financial literacy things that we've gone over in the past for our investors. You can also reach out to me on LinkedIn at Ryan Twomey. I think I'm the only one there, so you should be able to find me. And then also my email is ryan@trcapitalpartner.com. So feel free to reach out for any questions. Maybe you just want more insight on what we do, and I'm happy to share any resources we have. We like to provide free educational resources, whether you're going to do business with us or not, just to get people in that FIRE movement where they can technically take care of their finances and retire early. So yeah, that's pretty much where you can reach me.
Okay, that's fascinating. I will link all that into the show notes for you. And thank you so much for joining me on the show today, Ryan, and having this conversation.
Thank you. Appreciate you having me.